How is everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today we're going to be looking at the FDIC's 2024 Small Business Lending Survey. What kind of tidbits can we gather from this? How are banks, particularly community banks, doing with small business lending? Is turnaround time getting a better? Is technology playing a role in what's happening here? There's a lot of great things we can glean from this report. And we're going to look at two things today. We're going to look at a PCBB post, basically breaking down some of the information. And then we're going to take a quick look at the report itself. So this is the PCBB blog post here. It's called Building Stronger Bonds in Small Business Lending. Now, I'm not going to go into this, but they give a little kind of a little story about McDonald's here and kind of the founding of McDonald's and stuff like that. And I would tell you, if you've ever seen the movie The Founder with Michael Keaton, excellent movie, fantastic movie. I think it's one of the best movies that Michael Keaton has ever done. And definitely go and check that out if you want, just kind of get the gist of, the founding and history of McDonald's, great movie for that. And I'll definitely have to do a movie review on that one of these days, because it's a great movie. So, but anyway, let's get down to kind of the meat of what's going on here. So this basically says, as competition for small business relationships heats up, the FDIC's 2024 Small Business Lending Survey underscores the importance of balancing relationship-driven lending with emerging technology. By combining high-tech tools with high-touch service, CFIs or banks can adapt to evolving customer expectations while maintaining their edge in small business lending. So some of the insights from the survey. So the FDIC's 2024 Small Business Lending Survey highlights several key trends and metrics that emphasize the ongoing importance of relationship-driven lending for CFIs. So around 3 in 10 banks, including over 50% of large banks, can approve small loans within 1 business day, and 75% of banks can approve such loans within 5 business days. Banks rely more on soft info from personal relationships for underwriting, while large banks focus on hard data like credit scores, particularly for small loans. That's a little inaccurate. Basically, in underwriting, you have 3 types of data. You have soft data, hard data, and alternative data. Soft data is basically all the things that you know about a borrower. Like, in other words, Bob Smith is in the community, and we know that he goes to this church, and here's all his family members, and his cousin owns this business, his brother owns that business, his mother serves on this board. Like, just knowing all that, soft data, that local community type information, that type of information is critical for small banks when they're looking at the character, trying to do, the character being one of the 5 main C's of credit, trying to determine what is the character. We look a lot at soft data. Now, larger banks rely a lot more on hard data. Now, hard data is not credit scores. It's financial information. It's tax returns, financial statements, maybe accounts receivable aging report, inventory report, work in progress, that kind of stuff would be considered hard data. Alternative data would be considered things that are not like normally kept on, like, say, a credit report or in a tax return, like your apartment payments, your payments for rent, payments for your cell phone, payments for utility bills. Those kind of things would all be considered alternative data. And more of that alternative data is getting incorporated every year into small business lending. So, but I digress. Let's continue going on here. So, most small business borrowers are located near bank branches, revealing the critical role of physical networks in building and maintaining small business lending relationships. Around 50% of banks are considering fintech solutions in their small business lending, but very few allow borrowers to complete loan applications entirely online. And a lot of that has to do with fraud. It's not the technology, it's fraud. CFIs rely on personalized meetings to manage startup loan-related risks, while large banks are more likely to use government guarantees like SBA loans. So again, interesting data. And then there's an interesting chart here, percentage of banks using fintech in each step of the loan process by bank size. So we have larger banks here are in kind of like brown, and I guess the smaller banks here are in kind of a dark blue. But identifying potential borrowers, big banks more leaning on that. Loan application submission from borrowers, obviously more big banks using tech. Application processing by banks, big difference here again between large banks and small banks. Underwriting and decision-making process, again, huge difference there. Post-decision quality control, again, large discrepancy. But regulatory, this is interesting, regulatory compliance, AML, BSA, or KYC. KYC is know your customer. AML, anti-money laundering, BSA, Bank Secrecy Act. So not as big of a discrepancy there between big and small banks, 28 to 21%. So not a huge discrepancy there in terms of regulatory compliance. Closing process, large banks versus small banks, double. Loan funding, again, double. Loan performance tracking and servicing, again, pretty equal, 12 to 14. Or 12 versus 14. And then portfolio analytics, again, not a huge difference there, 15 to 10. So, but you can see there that basically banks of all sizes and shape are using fintech in some level of their loan process. And this is only going to continue to accelerate. The big conflict that you have, and again, this gets all into like loan automation, everything like that. The big conflict you have is between this collection of data, whether it's small data or hard data. When you're using a fully automated loan system, it's much harder to collect and utilize soft data in an automated loan process. Yes, you can put in things, but then how is it interpreted? How is it looked at in the scoring card and on the system and all that? Again, it's much easier in an automated system to use hard data or alternative data. But anyway, again, I digress. Let's keep moving along here. So then they recommend 5 actionable strategies here for CFI. So number 1 is investing in digital platforms with a human element. Number 2 is utilizing data analytics or tailored solutions, and that kind of gets into the, again, it's here. It says currently banks rely more on soft information for underwriting. However, by integrating analytics, they could complement relationship-based insights with more predictive, data-driven tools. So again, that gets back to that conversation of what kind of data are you using in the system. Number 3, enhancing relationship management skills. Training frontline staff to act as trusted advisors. Number 4. Collaborating strategically with fintechs. And then number 5, deepening community engagement. Well, and here's kind of the interesting thing. Do community banks or small banks have an issue with deepening community engagement? No, they do not. They're doing a great job with that. Collaborating strategically with fintechs, like that's become more of an issue recently with regulators putting more of an emphasis on that third-party vendor relationship and managing that relationship. That's become a much bigger issue, and we'll have to see how that plays out. And here's an interesting one: enhancing relationship management skills. Here's what I see as a big problem with this. You have too many of the big banks have turned their business development people into just simply, order takers. It's just go out, find the deal, bring it back, and then you're going to turn it over to the credit department, and then the credit department's going to tear it apart and let as either the lender or the business developer, what you can do, what you can offer, what the rate's going to be and everything. Like that frontline person doesn't really have a whole lot of say in what goes on there. Whereas at smaller banks, your lenders and your business development people are going to be very playing a key role in that they're going to be basically gathering all the information, putting it together, looking at it, and making it sure that it's something that's viable before they're even sending it to underwriting. And now again, to be fair, I'm sure that there's some of that going along at the big banks as well. But I'm just saying that at smaller banks, your relationship managers are better tailored to be that relationship manager, better tailored to be that trusted advisor, because they just have more control and more say over the process itself. So just like I said, it's an interesting, and I should do a whole episode just on that and digging into that whole aspect of a lot of that stuff. So, Okay, and then let's jump in, and then here's the report itself. And again, I put links to the blog and the report down in the description below if anybody wants to go and check those out. But let's just roll down here real quick I just want to look at the executive summary for a second here. And then let's blow this up so everybody can see it. So I just want to run through a couple of these things here. So, most banks lend to small businesses and retain the risk. Almost all banks participate in small business lending, which commonly includes loans of at least 1 million. Banks generally retain the risk of the small business loans that they make. Approval structures are fairly flat, and approval times are generally fast, especially for small and simple loans. Approval structures are typically flat with executives and board members often directly involved at small banks. Approval times are fast, especially for small loans at large banks. Technology has not replaced staff-intensive and relationship-oriented practices. About half of banks are using or considering using fintech in their small business lending process. Banks emphasize in-person and high-touch practices for developing relationships. The competitive advantage of banks reflects their investments in staff and local communities. Outside of credit cards, automated lending remains uncommon in the industry and is used almost exclusively for smaller loans. That's pretty interesting, right? Lending is largely local and focused around branch locations. The small business borrowers of a bank are generally located close to the bank's branch locations. Branches and on-site visits are key conduits for small business credit. The primary factors limiting the extent of geographic markets relate to competitive pressures and the challenges of maintaining relationships. Banks typically compete with similar sized or smaller local banks, though competition with non-banks seems to be increasing. Banks generally compete with banks of a similar or smaller size. Banks rarely compete intensively with banks that do not have a branch presence in the market. Competition with credit unions and other non-banks seems to have increased. There are key differences between small and large banks in small business lending. Compared to large banks, small banks generally use more soft information in their underwriting process. Most large banks make smaller loans using techniques and emphasize information from credit bureaus rather than more qualitative factors. Small banks are perceived by other banks as more flexible and able to lend to marginal borrowers. Large banks are more likely than small banks to make small loans without collateral. To manage the risk of lending to startups, large banks are more often rely on government guarantees, while small banks more often use soft information gleaned from meeting with applicants. So a lot of great information there, a lot of detailed, really interesting stuff there. And, we could dive. I mean, my gosh, I could dive into each one of those topics and do a whole episode just on each one of those factors. There's a lot of, so I just present this to try to give everybody a little bit of indication. Is like, so just, hey, how is small business lending going? So just to recap real quick, what we know is technology is playing an important factor in it and will continue to do so. Different types of data, soft, hard, alternative data play a key role in the process. Things are done very differently between big and small banks, and there are pros and cons to both. And I think that depending, if you're a business and you're going to select which bank you're going to use, you need to weigh those pros and cons. What do you really want out of it? What do you need versus what can the bank deliver? So you got to consider a number of factors there. But I think this is great information for everybody to know, for consumers to know, small businesses to know, for banks to know. So again, if you like this, you want to go check these reports out, I have links in the description down below, so please do go check them out. But I'll wrap this one up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And make sure to check out some of the other content on the channel. I appreciate everybody out there. Thank you so much for listening, and I will see everybody again real soon. Thanks a lot.